Okay, so hopefully you can see that now. So in case you hadn't guessed, I'm Sharon. And as the only female on the panel and in the room even, I think you might work out which one's me. So anyway, I'm Sharon from Argos Accounting. As a key part of your business, cash flow is crucial to your business. This needs planning and consideration in advance, which is why we'd always suggest, as Martin says, that you're keeping on top, and as James has alluded to, that you do regular cash flows. Cash flow forecasting is an attempt to estimate your future growth, and this is based on outcomes. So it's based on what's happened already, and with your management insight, it helps to plan and budget for going forward. It should be part of your financial structure and is particularly important at the moment for the areas that we're going to cover, which is repaying deferred VAT, bounce back loans, and CBILS loans, which are all coming up for repayment schedules now. So the ones we're going to look at, and I should have moved my slides on, apologies. The ones we're going to look at today is deferred VAT payments, bounce back loans, and Corona Business Interruption Loan Scheme, which is a bit of a mouthful. So everyone seems to have become known as CBILS, which everybody is very familiar with. So for the deferred VAT, you've got a few options here. So back in early 2020, you had the option to defer VAT for the quarters ending March, April, and May. This initiative was to support business and ease the cash flow burden at the beginning of the coronavirus. Time has now come to give consideration to repaying this. So all of these things were great at the time because it gave everybody that ease. Unfortunately, now we have got to think about repaying them all. And this is what we're now going to look on, and cash flow forecasting really comes into its own here. So you've got a few options to consider with deferred VAT. You can either repay the whole amount by the 31st of March, or you can opt to join the VAT deferral payment scheme. This has been available since the 23rd of February and finishes on the 21st of July 2021. Your third option is to speak to HMRC about extra help, and that needs to be done by the 30th of June 2021. The services need to be applied for online, and you need to do this yourself. It's not something your agent can do for you. You need to be up to date with your VAT returns, and you need to join the scheme by the 21st of June, as I mentioned. The first payment will be due when you join the scheme, and subsequent payments will be set up by direct debit. If you don't opt for one of these, you may be subject to interest charges and penalties. So it's really important that you do that. So the installments, as you can see from the slide, there's a number of ways and a number of months that you can split these over. If this is your preferred choice, our recommendation would be to apply for that as soon as you can. Because if you apply by the 19th of March, you have 11 months to repay. You can repay it sooner if you wish to, but you've got up to 11 months. If you leave that application until the 21st of April, your repayment time goes down, and it goes down to now 10 months. And as you can see, May goes down to 9 and June goes down to 8. So if you want to spread this over as many months as possible, the recommendation is to sign up for it as soon as you can. If you need any help, speak to your advisor or contact one of us. Bounce back loans. So these were very, very popular. The government rolled out bounce back loans to support small businesses with immediate cash flow challenge due to the coronavirus. This was launched on the 4th of May last year, and the scheme fast-tracked funding and is 100% government guaranteed for lenders. So the government will pay any interest for the first 12 months and no repayments are due in that period. Businesses who have taken out bounce back loans can refinance these into CBILS loans, and I'll tell you a little bit more about that in a few minutes. So on the 8th of February, the government also announced an extension to this, which made it easier for repayments, and you now have greater flexibility to repaying your loans. You can tailor payments according to your individual circumstances. The Chancellor modified his pay-as-you-grow scheme, which includes an option to delay payments for a further 6 months, meaning that businesses can choose to make no payments at all for the first 18 months from when they originally took their loans out. Pay as you grow also enables borrower to. Oh, sorry.
Oh, yeah.
Thanks for sending that code over. It looks like we're in.
Sorry. Thank you. Sorry about that, guys. So you also have the option to take an 18-month break, so defer payments for 18 months after you've taken your loans out. You can take a 6 months interest payment holiday, and you can do that for up to 3 times during the period of the loan. Lenders will be contacting borrowers to talk about the individual arrangements that they can tailor make for you and provide information for flexibility in repayment options. You still have time to apply for one of these loans should you want to, and you can apply up to the 31st of March this year. The loans are fixed at 2.5% per year for repayment and interest. Then moving on to the famous CBILS loans, as I alluded to. So what is a coronavirus business interruption loan scheme? What a mouthful. Thank heavens we came up with CBILS, hey? So since the pandemic started, the acronym of CBILS has become very common in the vocabulary of business owners and accountants, which is a bonus, isn't it? Announced by the government back in May, this type of loan is designed to offer a cheaper way of borrowing for businesses that were hit by the side effect or hit by the effect even of coronavirus. Through this scheme, it is possible to access 50,001, and it will become obvious why in a moment, up to £5 million can be borrowed through overdraft, loans, asset finance, or invoice finance. CBILS loans are interest-free for the first 12 months, and the government will cover the interest for that period. So there is interest being charged by the banks, but it's government covered. Businesses will benefit from lower initial repayments. However, you do remain liable for the entire repayment. So all of the capital repayment is the responsibility of the business. No personal guarantees have been required for these loans. Interest can vary between lenders, and it depends on your specific lending proposal. You need to speak to your lender to get full details of what rates have been applied and what rates will be applied after the government period of paying the interest stops. The term on these can range anywhere between 2 and 5 years. So with these, the government has not offered any money directly. Instead, what it did is it accredited 80 lenders who were charged with making these loans. The government provides a partial guarantee for small businesses, and it's basically so that you could get this loan during uncertain times. And we know the economy is up and down. It's been challenging for businesses to get loans, and this has been the solution. So as I mentioned, you're responsible for repaying 100% of your loan. And just like any other loan, the lenders will follow standard collection processes before making a claim against the government guarantee should there be a full shortfall. As with Bounce Back Loan, you have up until the 31st of March to apply for this loan. Moving on to then the final part. So the difference between the two loans, as I mentioned, this is where the 50,001 comes in for CBILS loans, because Bounce Back Loans covers everything to 50,000. You can turn your Bounce Back loan into a CBILS loan. What you can't do is hold both loans. So if you did turn it into a CBILS loan, you'd have to repay your Bounce Back loan first. Then moving on to the new announcement from the budget last week. This is announced that from April this year to the end of December 2021, a new loan has been established to give businesses access to between 25,000 and 10 million. The scheme will be open to all businesses, including those who have already had Bounce Back Loan or CBILS loans. So it's not like Bounce Back and CBILS, where you can only hold one or the other. This is open to anybody. There are some precursors effectively with this. This will be credit rated. So the loan is not a guaranteed you'll get if you can't go to a bank and say, I'd like £10 million, please, because they are going to do a credit check. And they are going to look at other loans that you have. So CBILS loans and Bounce Back loans will be considered as part of this. And they will then agree with you how much they're prepared to lend you. The loan could be asset finance again. It could be invoice finance, overdrafts, and you've got up to between 3 and 5 years to repay this. So I hope that gives you a little bit of insight and plenty of food for thoughts, and highlights the need for cash flow forecasting within your business. I appreciate it can be an absolute minefield. And if you need any help with this, please speak to one of my colleagues on the panel or myself, and we will be very happy to guide you through. And now we're happy to take questions.